IND AS 1, Presentation of Financial Statements, the Language of Financial Reporting. Hello and welcome to candymentor. In this session, we'll unpack IND AS 1, the standard that defines how financial statements should look, what they must contain, and how to present information so users can make economic decisions confidently. We'll keep it practical, step-by-step, and TTS-friendly. Objective of IND AS 1. The goal is simple. Set the rules for presenting general-purpose financial statements. IND AS 1 ensures consistency across periods and companies. It makes reports structured, comparable, and understandable. Most importantly, it insists on fair presentation and compliance with IND AS. That builds trust for investors, lenders, and regulators. Scope and coverage. IND AS 1 applies to all general-purpose financial statements prepared under IND AS. It does not apply to interim reports. That's IND AS 34. Nor does it govern special-purpose regulatory filings. If you prepare full-year financials under IND AS 1, IND AS 1 is your backbone. Purpose of financial statements. Financial statements exist to show a true and fair view. They explain financial position, performance, and cash flows. Users rely on them to judge profitability, liquidity, and solvency. They also inform decisions about efficiency and future financing needs. So clarity and completeness are not optional, they are essential. Complete set of financial statements. A complete set includes these items. 1. Balance sheet, statement of financial position. 2. Statement of profit and loss, including other comprehensive income, OCI. 3. Statement of changes in equity. 4. Statement of cash flows, IND AS 7. 5. Notes to the financial statements, plus comparative information, and a third balance sheet if retrospective restatement is needed. Fair presentation and compliance. You must comply with applicable IND AS standards. A departure if allowed only in extremely rare cases. If you depart, disclose why and show the financial impact. But remember, departure is the exception, not the rule. Faithful presentation beats technical compliance when they conflict. But explain it fully. All right. Going concern assumption. Management must assess the entity's ability to continue for the foreseeable future, typically 12 months. If going concern is not appropriate, prepare statements on a liquidation basis. If there is significant doubt, disclose it and explain why. This assessment affects measurement, classification, and disclosure choices. Accrual basis of accounting. Prepare financials on an accrual basis, not cash basis. Recognize income when earned, expenses when incurred. This approach matches cause and effect. The cash flow statement is the exception. It shows actual cash movements. Consistency and comparability. Use consistent presentation and classification across periods. Changes are allowed only if required by a new IND AS or if they improve relevance. When you change, explain why and restate comparatives if needed. Consistency helps users compare trends without guesswork. All right. Materiality and aggregation. Materiality is about user decisions, not just numbers. If omission or misstatement could influence decisions, it's material. Aggregate immaterial items, but present material items separately. Materiality is entity-specific. There's no universal numeric threshold. Offsetting principles. Do not offset assets and liabilities or income and expenses unless IND AS permits it. Show revenue and costs gross, typically. Offsetting is allowed in limited cases, for example, certain hedging or disposal gains. Gross presentation gives clearer information to users. Current versus non-current classification. Classify items as current if they will be realized or settled within 12 months. Examples: inventory, trade receivables, short-term borrowings. Everything else is non-current, long-term assets and liabilities. This split helps assess short-term liquidity versus long-term funding. End quote. Components of Statement of Financial Position. Key line items include property, plant, and equipment. Intangibles, investment property. Also inventories, trade receivables, cash and cash equivalents. On the liability side, borrowings, trade payables, provisions, and deferred tax. Equity shows share capital, reserves, and retained earnings. Add subclassifications where helpful for clarity. Statement of Profit and Loss, P&L. P&L must present revenue, finance costs, share of profit or loss of associates, and tax expense. Show profit or loss for the period clearly. Include other comprehensive income, OCI, items separately. OCI items are those that bypass P&L for now, but may reclassify later. Other comprehensive income, OCI explained. OCI examples: revaluation gains, actuarial gains, losses, foreign currency translation differences, and fair value changes in certain investments. Separate OCI items into two groups: those that will be reclassified to P&L later, and those that will not. Present them clearly so users know which items may affect future profit. Statement of Changes in Equity, SOCI. SOCI reconciles opening and closing balances of equity components. It shows total comprehensive income, owner transactions like dividends, and retrospective restatements. Use it to explain movements in share capital, reserves, and retained earnings. A clean SOCI builds investor confidence. Statement of Cash Flows. The cash flow statement is prepared under IND AS 7. It's part of the complete set required by IND AS 1. Categorize cash flows into operating, investing, and financing activities. This statement reveals cash generation and usage not obvious from P&L. End. Notes to financial statements. Notes carry supporting detail that the primary statements don't show. Include significant accounting policies, disaggregation of key items, contingencies, and commitments. Also, disclose judgments and estimates, and related party transactions as per IND AS 24. Notes turn numbers into a usable story. 1. Disclosure of accounting policies. Place significant accounting policies together. Usually Note 1. Avoid repeating trivial policies. Explain choices clearly. Measurement bases, cost formulas, revenue recognition timing. Good policy disclosure reduces audit queries and user confusion. Judgments and key estimates. Disclose judgments that significantly affect results. Examples: revenue cutoff timing, lease versus finance classification, valuation of complex instruments, and impairment assumptions. State key sources of estimation uncertainty and possible impact ranges. This helps users assess risk and reliability. Minimum information requirements. Certain line items must appear on the face of primary statements. Examples on the balance sheet: PPE, intangibles, inventories, receivables, payables, equity, and tax items. On the P&L, revenue, finance cost, depreciation, tax expense, and OCI items. Structure is flexible, but must be clear and informative. End. Capital management disclosure. Describe objectives, policies, and processes for managing capital. Include externally imposed requirements, like debt covenants. Explain any changes and actions taken to comply. Investors look at this to assess solvency and covenant risk. Comparative information. Present comparatives for prior periods for all items. If you change presentation, restate comparative figures or explain why not. When you restate retrospectively, you may need a third balance sheet. Comparatives let users see trends and detect shifts. Extraordinary items. Extraordinary items are prohibited under IND AS. Do not label income or expenses as extraordinary. All items must flow through P&L or OCI as appropriate. This avoids subjective labeling and preserves comparability. End. Departure from IND AS is allowed only in extremely rare cases. You must disclose why the departure gives a fairer presentation. State the nature of the departure and its financial effect. This is a high bar. Document it thoroughly. Closing summary. IND AS 1 is the framework that shapes all financial statements. It enforces fair presentation, consistency, and clear disclosure. Follow the accrual basis. Classify current versus non-current correctly, and explain judgments and policies. A well-prepared set of financial statements is both compliant and communicative. Final takeaway. IND AS 1 is the language rules for financial reporting. It does not change the numbers. It changes how those numbers speak to users. Master IND AS 1, and your reports will be clear, comparable, and credible.